Which year do you think that I'm talking about? Stocks are overvalued, speculators borrowing money to leverage their investment, the economy outwardly doing quite well, but consumer credit, consumer debt rising rapidly, house prices overvalued, and a wave of optimism and enthusiasm based on new technology but is going to change the economy. Well, it could be 2001, 2007, or perhaps even 2025. But one difference about 2025 is that we also have a new range of factors to contend with, which could be quite damaging. Economic growth is slowing down. Societies are aging. There's a very real threat of a global trade war, and the global financial system is more integrated than ever before. The 2008 credit crisis didn't lead to a new world of careful, responsible finance. It really just showed markets that there was nothing they couldn't get away with. Now, there is a golden rule that investors like to hold on to. The US stock market has averaged returns of 10% since the start of the last century. Who cares about the odd crash, which is more like a temporary setback? Even if you buy just before the last financial crisis, you would still be sitting on big gains today. But this 10% rule is not set in stone. Japan is a pathfinder for an aging economy in retreat. Did you know that Japanese stocks are basically the same level as 36 years ago, back in the boom years of 1989? That's basically 0% growth for the past 36 years. Japanese house prices still lower than that peak time in the early 80s. The 20th century saw unprecedented growth in rising living standards, rising GDP, and rising corporate profit. But global economic growth has been slowing down in recent decades. This shows the combined growth rate of Japan, Europe, and the United States. In recent years, there's a clear downward trend in the rate of growth. The post-war economic boom is largely over. Even China, which was once growing at 10% a year, is now having its own problems. One reason for different growth prospects is that global demographics are rapidly changing. Birth rates are heading towards record lows. Firstly, societies will age, and then towards the end of the century, populations will start to decline. The ageing of society and fall in birth rates will put pressure on government welfare spending and pensions. This is projections for the UK. Unless the government changed policy, debt is forecast to rise sharply. But reducing something like pensions is very difficult politically, and it's no different in the United States, with debt set to rise sharply. And President Trump is not known for his fiscal conservatism. If anything, the US is likely to see bigger budget deficits because of large tax cuts probably coming this year. So demographics will be a challenge, but it doesn't stop there. The world is seeing rising global temperatures, global warming, and an increased number of extreme weather events, which can be very costly to the economy. The cost of home insurance has more than doubled in the past few decades. In the US, locations vulnerable to extreme weather events may struggle to get any insurance at all. Already insurance losses have increased, and this places pressure on households, firms, and the government. With weather becoming more unpredictable and volatile, there's a risk of much bigger losses to come. Insurance losses could cascade through the global financial system, putting a lot of pressure on governments and firms who are already stretched. There also remains the risk of higher cost-push inflation coming down the line. For example, rising food prices this year, even a shortage of raw materials, shortage of things like water, can put upward pressure on prices. In 2022, we saw the devastating effect of cost-push inflation, with people squeezed from rising prices and real wages not keeping up. But another bigger cloud on the horizon in the short term is a threat of a major trade war. Now, if President Trump would impose the tariffs he's talked about, it could lead to the highest tariff level since the Great Depression. Free trade definitely has its critics, but it did achieve two things. Firstly, it kept prices down. Cheap goods from China helped reduce inflationary pressure in the West. Secondly, it was very profitable for multinationals, who were able to shift manufacturing to the lower cost places for different parts of production. US corporate profit has soared in recent decades, not just rising in real terms, but as a share of GDP too. Free trade means production is no longer based in one country. Everything is interlinked. The iPhone in your pocket is made and designed in over 43 different countries. The US car industry relies heavily on importing raw materials from Canada and components from Mexico. So the current global economy is very much reliant on the current system of low tariffs and modular production. It leads to large economies of scale and large profits for the companies involved. Now, if President Trump's threat to place large-scale tariffs materializes, it will be a really big shock to the global economic system, but has served Wall Street very well up until now. And it's a risk not currently reflected in market prices, which are near record highs, price to earnings really very high compared to historical trends. Markets are really kind of assuming that the past global trading system will remain largely intact. But maybe it's something markets don't really want to accept, the inconvenient truth that the future may be a very different world. Of course, there is uncertainty about how much tariffs will actually be increased. For example, the threatened 20% tariffs on China and Mexico were delayed for 30 days and may never actually be implemented. Even this uncertainty is enough for firms to think twice about cross-border investment because it raises costs and deters investment. Currently, the US is looking into reciprocal tariffs, and this could lead to big shocks. For example, Colombia has a 70% tariff on coffee imports to protect its coffee industry. Now, if the US were to retaliate like for like, it would lead to a big shock for American coffee drinkers. If the US economy did get into any kind of difficulties, it's quite likely that it would put more pressure to put up tariffs. This is exactly what happened in the 1930s. In the Great Depression, rising unemployment caused workers to pressure politicians to protect their industries. But whilst this may provide some short-term help for some industries, higher tariffs led to cascading negative effects, higher prices, reciprocal tariffs, lower exports, lower demand in the economy. It's widely acknowledged that the Smoot-Hawley tariffs didn't cause the Great Depression, but they did make it last longer and made it deeper. And this is why the global economy will be very vulnerable to any kind of higher tariffs, which lead to kind of tit-for-tat retaliation. Now, after the 2008 crash, many were left wondering how come problems in the Florida housing market caused such widespread financial turmoil around the world. It was an insight into how global economic finance is increasingly integrated and reliant on liquidity of the financial sector. Basically, commercial banks around the world were buying US subprime mortgage debt without ever realizing what they were really buying. Credit rating agencies gave these risky assets a AAA credit rating, they're safe and secure, so banks, with a lack of investigation, never realised how much they were exposed to bad debt. In 2008, the Royal Bank of Scotland went bust, and Alistair Darling, the then Chancellor, tells how the chairman of a bank promised him after the bailout that from now on, they will only take on risk that they understand. It's a revealing insight into how financial markets were rewarded for taking on risk. Because if they took on risk and they succeeded, they made huge bonuses. If they failed, it was the taxpayer who bailed them out. But the big question is, has anything changed since 2008? I mean, there were new regulations, Dodd-Frank in the US, higher capital requirements. But arguably this is mere tinkering at the edges. Global finance has not been fundamentally reformed. We still have those perverse incentives where risk is rewarded, institutions are too big to fail, and the implicit assumption that governments will bail out and act as lender of last resort. So a cynical view may be to say that since the government spent billions bailing out the banks last time, the big lesson of a credit crunch is not that finance needed to be fundamentally reformed, but there's really nothing that the big banks can't get away with. Even in 2023, the US saw medium-sized banks like Silicon Valley, Signature Bank and First Republic all go bust. Yet despite high risk in the financial system, the new Trump administration is looking to deregulate further. And with deregulation and tax cuts, this may lead to strong growth short term, but it is exactly the kind of thing that can lead to a further build-up of an asset bubble, the kind of boom and bust dynamic we've seen so many times in recent history. And also another problem with finance is that regulators are often fighting the last battle. Last time it was all about subprime mortgages, credit default swaps, collateralized debt obligations. But financial markets are very adept at moving on, creating new instruments. A big growth area in recent years is a growth in non-bank operations, new forms of money and lending, and crypto. There's been a surge in risk-taking amongst investors and speculators, leveraged stocks, meme coins, etc. US savings have fallen really quite rapidly amongst households because money has been put into stocks. If sentiment changes, it could have a very large impact on financial markets and the economy. And one thing we definitely learned from the last credit crunch is the psychology of human behaviour. We tend to follow the herd. If meme coins soar, we want to join the rush. We don't want to miss out. But then millions get burned when prices fall. It's really not a question of if financial markets crash. It's really a question of when and how deep will it be. In 1987, the stock market fell 25%, but with the help of federal intervention, it bounced back and the economy was largely unaffected. In 2008, markets crashed and it precipitated real panic, financial hardship, and a lost decade of austerity, low growth, and rising inequality. Now, like a stuck clock, if you predict a crash, you are going to be right some of the time. We will eventually have some kind of crash. But even putting that to a side, I think in 2025 there are quite a few new threats that were not around in the post-war period. What's happened in the past, in the 60s and 70s, where a period of growth, is not necessarily going to happen in the coming decades. But the further we look ahead, the harder it is to know what's actually going to happen. But in the short term, this video focuses on the new wave of speculation and risk-taking and why American households are taking on more debt and risk.